much for coming. It's great to get people out here on a Saturday afternoon. I really appreciate it. I know it's sometimes hard to get out of the house, particularly if it's raining and a little bit cool. And thank you for coming. And also thank you very much to Molly and everybody at Democracy North Carolina for hosting this event. Democracy North Carolina is an incredibly important organization in the state. Anyone who's looking at the relationship between politics and money in North Carolina or any other state is really looking at the crux of the problem. And so I really congratulate them on the work that they do every day and do really, really well. Part of the story I want to tell today is going to weave in some of the work that Democracy North Carolina did last summer. It's very, very important to the work the issues that I work on. So I work for this group that most of you probably not heard of. It's called the Center for Responsible Lending. We are part of Self-Help. Self-Help is one of the largest community development lenders, the name of the trade associations, community development financial institutions. We're one of the largest in the country. We were created in 1980, and our core business is lending. Self-Help makes home loans, and we make small business loans. And we make 80% of those loans to low and moderate income families. And again, have been doing that since 1980 in North Carolina. So we're a lender. And I have to say, in all honesty, we're a subprime lender. And we said that very proudly for many years because we make loans to people who don't qualify for regular bank loans. That was before subprime became a really nasty name, a really nasty word. But the reality is that the problem with lending to lower income families is not inherent. The problem and the crisis that was created by banks and other financial institutions was created because they gave those families bad loans. If you gave those same families good loans, they would be performing and they would still be living in those homes. That's just the long and short of it. So the problem of predatory lending, this is a phrase, when I started working in Self-Help, nobody in that institution, and we were pretty big at that time, we've been around for a while, nobody had ever heard the phrase predatory lending. Never been said. A couple people around the country and some other places, Atlanta, a few other places, were starting to talk about this problem of predatory lending. But basically, it was hidden, and nobody knew anything about it. But then at Self-Help, what happened was that we started having homeowners come to us to refinance their home loan. And we started looking at their loan documents and just couldn't believe it. I mean, these loans made no sense at all. And at first we thought, there's got to be a mistake here. Nobody made this loan. And then we realized, oh yeah, there are people out there making these loans every day. And the fact that these loans were being made to lower and moderate income families meant that it really cut to the core of our mission. Our mission is to get a family into a home and keep them in that home. And the reality is that there are these bad lenders out there that will make a loan to basically anybody who can fog a mirror. They can take our good home loans and flip them out. And then down the road, those people lose their homes because the home loans were just not sustainable. So you folks have seen where that took us. Not a pretty picture. I want to talk, when Molly first talked to us about coming and talking about sort of money and politics and issues of predatory lending, my first thought was, oh my God, where do you start? We've been doing this since the late 1990s, again, as we first started talking about what is predatory lending. Ever since the beginning, we are always up against huge corporate interests, extremely well-funded corporate interests, and clear sense that those people are calling shots in too many cases at the General Assembly. I was at the General Assembly one time, and this lawyer turned to one of the lobbyists for a financial company, and he said something like, I can't remember exactly what it was, but something along the lines of, did I do what I was supposed to do for you today? No. Oh, and I thought, they never turned to me and asked that, They're not asking me, oh, did I do what I was supposed to do for you today? I don't think that's really how this picture goes. But I just sat there and went, oh my my God. That's how commonplace it is that this is, that this is the problem that we're facing. We work in, we started out our work at the Center for Responsible Lending just in North Carolina. So Help just lent in North Carolina initially. Our work was just in North Carolina. Our policy work was just in North Carolina. Predatory lending work was just in North Carolina. But now we started working with a number of other states. So we work in probably 24 states at least every year on some sort of predatory lending issue. And we had these meetings recently where we try to predict. General assemblies all across the country are coming back to town in January. Ours is not. They're not back till May, thank God. Got a little break. But all across the country, they're coming back in January. And we're trying to predict where the problem's going to be for predatory lending when these new general assemblies come back to their state capitals. So, we could do a lot of things to predict that. We could talk to leaders in the legislature. We could talk to regulators, attorney generals, banking commissioners. We could talk to chairs of relevant committees, like the banking committee, for instance, or Speaker of the House, just leaders of the legislature. That's not what we do. We look at what do the campaign contributions look like and who's registered lobbyists. And then without a doubt, what issues will be coming up in that state in that next session. It's a foolproof approach, unfortunately. And I'm going to backtrack a little bit now, and this is back to the thing I mentioned in the beginning that I would talk about, the role of democracy in North Carolina and one of the issues that we worked on this year in North Carolina. And I want to sort of bring this back to a bill that is probably not going to seem that significant in the grand scheme of lending, but it is very important in the sense that it sets a trend in our state. North Carolina has been very protective of consumers in the realm of predatory lending. In general, we are considered a model across the country. That doesn't mean we don't have any problems, doesn't mean we don't have 70,000, well, I guess last year wasn't 70,000 foreclosure filings, but we're down to a smaller number, 63,000 foreclosure filings. Doesn't mean we don't have problems here at all. But North Carolina has not been as ravaged as a lot of states. And we have significant protections that are not in place in many states across the country. But there's a bill that popped up last year. It's called House Bill 810. And this bill is a bill that would increase the interest rates and the fees on small loans in the state. So I don't know if y'all have followed the issue of payday lending. Payday lending was legal in North Carolina for 4 years. It operated illegally for another 5 years after that. And then we have effectively gotten storefront payday lenders off the street in North Carolina. This was the first state ever to roll back a once legal payday industry. It has saved us probably $150 million every year out of the pockets of poor people by not having 400% payday loans on the street. So what happened with this new bill, House Bill 810, was that basically the finance companies wrote the legislation, they always do, and it would, again, increase the interest rates. So once the payday lenders left, we have a core usury cap in North Carolina that's 36%. That's the base, pretty high, sounds pretty high. You can charge 36% pure interest on a small loan in North Carolina. You pay it back in installments. The lenders do some basic underwriting, and it's not a perfect loan. There's some problems with it, but we have generally been accepting the fact that that's a reasonable industry to have on the ground in this state. Who are these lenders? We talk about consumer finance companies. You probably have no idea what that is, and they keep changing their name. So if you know who they were yesterday, you don't necessarily know who they are today or tomorrow. So the biggest ones are City Financial, part of Citigroup, now going by the name of One Main Financial. sort of sounds like, Main Street lender. That's the idea behind it. Another one you probably heard of, American General. A lot of these guys were very involved in subprime mortgage lending. What I'm talking about now is not tied to it's not a mortgage, it's a personal consumer loan. American General also changed their name, Springleaf. Sounds nice, doesn't it? I love these names. One name, Springleaf, oh, it's so friendly. American General, owned by AIG and a New York hedge fund. So you can sort of see where this is going. Another large one, the third largest, is a regional finance company, and it's security. It's called Security Finance. It's based out of South Carolina. So this industry is at the General Assembly presenting itself as sort of mom and pop lenders, when the reality is that 60% of the loan volume is done by these large companies, and if you increase the rates on these loans, the money is going to go directly to City Financial, AIG, New York Hedge Fund, and South Carolina. Doesn't stay in the state, doesn't help us, feeds directly out. They're proposing, they can already charge, as I said, 36%, that's flat interest. The real, what we talk about in our industry is a combination of what a loan looks like when you combine interest and fees, because there's lots of playing around and funny business with fees, so you really have to look at the picture with both to figure out the true cost of a loan. The APR, that's the annualized percentage rate, which takes into effect the fees and the interest on the smallest of these loans, is already 54%. 54%. They would like to take it to 100. That's what they're proposing. It doesn't look like that. You have to, I tell you, we have very, very smart people on our staff. I am not one of them in this particular field, but we have people who, we had a woman on our staff who literally wrote the book on usury for the National Consumer Law Center. And it took her an hour to figure out what the APR would be on these loans, because it's such a complicated structure. So I'll guarantee you the General Assembly members do not have any idea. And if we say it's 100% and the industry says, oh, it's 36, because that's the pure interest rate, and then they're not counting in the fees and all this other stuff, guess what? The General Assembly tends to side with what the industry tells them. Not always. I'd say we have a pretty good reputation with the General Assembly. We've been giving them reliable information on financial issues for a number of years now, but it is a bit of an uphill battle. The problem with this industry is not just the high interest, it's the fact that people don't get out of these loans. This was the same problem with bad subprime loans. It's the scenario with bad loans typically is that the borrowers end up basically in some sort of cycle of debt, staying in debt, sometimes increasingly going into increasingly higher levels of debt, and exactly the same thing in this industry. What happens is that you make a loan to somebody who is on the margins of being able to pay that loan, afford that loan, and then some blip happens, and they can't afford it, and they fall behind, and the company says, no problem, we can refinance you. So every time you get refinanced, just the same thing with the home loans, no problem, we can refinance you. In the home loans, of course, they're pulling equity out of your home. That was the scenario. That's like the house of cards that fell when housing prices started to decline. With these loans, they're just draining more and more of your family income to service this debt. And so the borrowers are coming further and further behind and staying in these loans for a long period of time. 80% of the loans go to either an existing customer, just a straight flip, refinancing an existing loan, or they go to a customer that has had a loan with this company in the past, a recent customer. So in general, we don't think repeat business is a bad thing for most industries. For high-cost lending, repeat business is a problem for the consumer. You don't want consumers continually getting high-cost loans. They will just drown in debt, basically. So with this bill, I think I need to speed up, I'm getting too long-winded. This bill was opposed by everybody in the state, with the exception of the industry. The governor said it was a bad idea. hinting that she would probably veto it if it got to her desk. The Attorney General spoke up and said, really bad bill. All the groups that you've heard about that we are in coalition with on so many issues, the Justice Center, ARP, NAACP, AFL, all of these groups, consumer credit counseling organizations, anybody who's in a service role with people that are in these loans, all opposed it. All led to the General Assembly saying this is a really terrible idea. We should not pass this bill. There was a huge amount of press against this bill. So nobody's supporting this bill, right, except for the industry. The long and short, it's pretty easy when you start looking at, and this is where I want to give credit to Democracy North Carolina. When you start looking at the money flowing into the General Assembly before session and into campaigns before the session began, then you get the picture. The Resident Lenders of North Carolina, which is one of the trade associations, another one is called the Financial Services Association of North Carolina, in a very unusual move, starting in August of 2010, they started making a lot of campaign contributions towards not even incumbents, these people aren't elected yet, people who are running, Republicans who are running in very tight district races where the Democrat is perceived as vulnerable. It's a big gamble. But they put in more money in a couple months than they had put into campaigns in combined 10 years before. Huge amount of money flooding into these campaigns, as well as to 3 leaders at the General Assembly. The Majority Leader, and the Speaker of the House, and the President of the Senate. So it was a good gamble for them. A lot of these people got elected. And the message that we were getting from our friends at the General Assembly was, and we do have friends at the General Assembly, but not everybody's bad. I'm sorry. It was that, there are a lot of people who want to vote against this bill. They don't think it's good policy. They don't think it's good for their constituents. They don't want to be on record voting for higher interest rates. It's not a smart political move, but there's just so much arm twisting from the House leaders that they don't feel like they can. They have to vote party line with the House leaders. And to a large extent, they did. The bill passed the House. It was a pretty narrow margin, 60 to 55. It's actually 61 to 54. Then one of the legislators changed his vote like 2 weeks later. I thought that was interesting. Would you like to know how representatives from this area voted? Are you interested? Okay. Voting for increase in interest rates, high cost lending. Jeff Collins from Rocky Mount, also a co-sponsor of the bill. Michael Ray from Gaston, also a co-sponsor. Lynn Bradley. The 3 that I pulled up when I looked at sort of the counties that are right around here. I do have a, if you want to come back at the end, I do have the vote count for everybody. If you've got another legislator you're interested in, or take my card and call me. Opposing the bill, Angela Bryant, Joe Tolson, and Jean Farmer Butterfield. So give them your thanks next time you see them. We appreciate their support. I would say that there's a little bit of a silver lining. This bill was so contentious at in the House that the Senate, with I think some cooler heads prevailing, said, I'm not sure we really want to be voting on this bill, particularly since we got an election year coming up next year. So the bill is stuck in the Rules Committee in the Senate. We hope it stays stuck in the Rules Committee in the Senate. That would be the best scenario. But I would say that they are still lobbying very, very hard. The industry has hired extremely friendly ex-military to be on their lobbying team. They are asking to go to DOD to speak to people in Washington. So this industry that basically says it has no money because it can't operate under the current rate structure is spending all this money pushing for this bill, giving $100,000 away to get people elected. And interestingly, in a similar issue in Missouri, there's a ballot measure, a citizens ballot measure in Missouri that would cap all loans at 36%. they came up with $500,000 in 2 weeks. So this is not exactly people that are struggling to get by. I apologize to anybody here who might be in this sector, but come talk to me later. Anyway, I am a big, I'm a big believer in democracy with a little d. I see it work all the time. I think the fact that this bill is stalled in the Senate is the fact that people got so engaged and spoke up loudly and clearly. And I, sort of like Jim was saying, I look forward to having more citizens' victories in the future as we shed light on these issues. And I, again, thank Democracy North Carolina for its work to do the hard work of crunching the numbers on who's giving money and where it's going when. So, thank you very much.